Bo Fisher, Fisher and Wiens Wealth Management. It has been a little over a half a year since I sent my last video out, which I sent it out in January. And if you remember in that video, we had just gone through December of 2018, which was one of the worst Decembers since the Great Depression. Wasn't much fun. And yet in that video, I showed a lot of statistics on why the markets, stock market specifically, actually should do pretty well. Here we are about a half year later, and lo and behold, the markets actually have done pretty well during that 6 or 7 month period since January. Now, where are we today? We're in a different place. I'm not as confident as I was in January that our markets are going to do well, and I'm going to talk about that. But there's a big tension that's happening. We have some really positive things that are happening, and we have some really negative things that are happening. So let's discuss it. First, let's talk about some of the reasons why we have some concern about the markets. We still have China that we're negotiating with. There's a trade war going on. Now that really started last year's fluctuation in the markets, some nervousness about China and the trade war. And why does that matter? Why is it such a big deal that we have this trade war with China? Well, China's a big country, a lot of people. And to put that in terms of what it means in the United States, well, there are a little over 300 million people in the United States total. In China, the millennials, basically someone between, let's say, 20 and 30 years old, getting into the workforce, right about to start spending money, the millennials in China equate to about 400 million people, just the millennials. So once again, United States total, a little over 300 million, the millennials in China, 400 million, let alone all the other people. So it's an enormous market. And so when we have issues with China and our companies can't sell to those millennials, that's a problem. So that is making the markets nervous. We also haven't had a recession for about 10 years. The last one we had, Great Recession, everybody's familiar with it, 2007, 8, and 9, it bottomed out. So it's been about 10 years since our last recession. We're kind of due for one. They come roughly every 10 years. And so we should expect one coming up here pretty soon at some point. And the last thing is there is something called a yield curve. And let me show you a chart. In this chart, you're going to see a normal yield curve. And what a yield curve is, let's imagine you go into the bank and you say that you want to have a secure investment, so you're going to buy a CD, and you say that you're willing to give the bank your money for 6 months. So the bank says that they're going to pay you 1.5% if you lock your money in for 6 months. And you say, that's fine. But what if you decide that you can give the bank your money for 10 years? You would expect the bank to pay you a lot more. And in this chart, they would. They would pay you, let's say, a little over 3% per year to lock it in for 10 years. So the longer you lock your money in, the more you make. That makes sense. That's a normal curve. Well, let me show you where we are today. This chart actually is showing you what's happening. It's called inverted yield curve, which means that you go into a bank, you say, I want a short-term CD, 6 months. They say in this chart, we'll pay you about 2%. And you say, well, I'll tell you what if I lock my money in for 10 years? And they're going to actually say, we'll pay you 1.5%, less than if you lock it for short-term. It's almost hard to fathom what in the world's happening there. But what's happening is that there are so many people fearful of the markets moving forward that they're locking in their money for longer periods of time, which is driving yields down. This has happened only a handful of times over the last 60 years. In every recession since 1950, this inverted yield curve has happened. So once again, every recession that has happened since 1950, the yield curve inverted just like what's happening today. So that would kind of indicate we're moving towards a recession. But here are some of the positives. So those are the negatives on why I'm a little nervous about the markets. But here are some of the positives. I'm going to stay on that yield curve. That yield curve has actually come before every recession. However, it has also come about 6 other times where a recession didn't happen. So it's not a perfect indicator. It just has actually indicated recessions correctly, but not always. So that's one reason that we have to be a little bit tempered. But most importantly, our unemployment number is there. It's 3.7%. So government standards say that a full employment is when there are about 5% of our country not working, because there's always going to be people moving or not wanting to work or changing jobs. So about 5% of the population, when 5% of the population doesn't have a job, the government figures it's full employment. We're at 3.7% unemployment numbers, which means that we can lose a couple million jobs before we get back to even full employment government standards. That's a beautiful thing. Our economy is driven by consumers. When people are working, they buy t-shirts and TVs and cars and tennis shoes, etc. And when they buy those things, those companies make money, which means they hire people, which means those people who just got hired have money to spend on TVs and cars, etc., 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 and our economy is moving. That's what's going on. And so that would really give us comfort that our market is going to continue to do well. So that's the first positive. The second positive is this chart here. So what I'm showing you now is the stock market basically since before the Great Depression. The blue is where we've had expansion in our economy and expansion in the stock market, and the yellow is when there are recessions and downturns. And what you're going to see here is that during the long expansion times of a little over 10 years, somewhere between 12 years even, is that we've had some really good long expansions. And on the very right side, you can see our current expansion. It's been about 10 years. But what's interesting is if you look at the amplitude, how much money, what percent has the stock market gone up during those expansions? I'm going to show you here. And so you can see that in the 50s to 60s, the stock market gained 900%. In the 70s and 80s, it gained 760%. In the 90s, it gained 800%. Well, currently, even though we've had almost a 10-year expansion, our current expansion has only gained about 400%. Now, 400% is a big number, but compared to most expansions, it's only about half. So we could actually have a significant expansion continue because the gain has not been that great during our expansion. It's been a long expansion time-wise, but not amplitude. So that points towards we're not overheating. We have good, really low unemployment. We have a strong economy, and the expansion has not actually created huge rates of return yet. So those are reasons why we want to have money in the stock market. So we have conflicting things that we're looking at. We have concerns about China and yield curve, and we haven't had a recession for a long time. But we also have really positive things like unemployment's really low, and our expansion actually has not been that great amplitude-wise. So what do we do about it? Well, we stay diverse. We stay diverse because stock market we want to be engaged with if the expansion continues, but we need to have money in fixed income. What I'm showing you now is a chart of the stock market is the red line and fixed income is the blue line. And what you're going to see is when the stock market goes down, fixed income has actually gone up. There's an inverse relationship. Stock market goes down, bond market and fixed income goes up. And so by having both of these in our portfolio, we can hedge these mixed signals. And that's what we're doing in your portfolios. We're being very diverse and we're being very strategic and making sure we don't overweight either one of these sectors as best we can. So we have some mixed signals right now in the markets. I'm watching them like crazy. We're being very careful, but we are staying diverse in your portfolio. And so if you want to talk about this, what I'm talking about in this video, if you want to have a meeting, just give us a call. We're always here to chat. We can talk on the phone. We can do a Zoom conference. We can meet face to face. Just let me know what's going on in your life. So until the next video or until we get to see each other, enjoy what's left of the summer and moving into fall.